Good morning, guys. It is Thursday, April 16th, 2024. This Bathrobe Business. I'm Georgi Oganov. I'm out of coffee, but I still have the news. I'm also going crazy because allergy season is in full swing in Utah, and it just hit me like a freight train yesterday and is not letting go. Let's get into it. There are a couple stories I want to talk about. Like I said, I guess I didn't say, but there wasn't a video yesterday. I'm just doing videos now, probably around 3 to 4 times a week, just because I feel like if there's not if there's not information in the market that I think is valuable, I'm just not going to make a post. So let's jump into inflation data. So inflation data came out yesterday. This isn't a news story. You guys have probably heard the CPI actually had a decrease for the first time in like 6 months to 0.3% from the month of March. So for April numbers. On a 12-month basis, however, the CPI is still up 3.4%. So it's still 1.5% essentially above the inflationary target set by the Fed at 2%. So even though this is a nice little blip, I don't think that this is going to change much, and I don't think that this is an actual trend. I think this really is just a blip because other inflation data we've gotten in the last couple of months has shown that inflation is still very high. This is a story also in regards to the interest rates as they'll relate to inflation. New York Federal Reserve John Williams said, restrictive is in a good place right now. I don't see any indication now telling me there's a reason to change the stance on monetary policy, and I don't expect that the greater confidence that we need to see on the inflation progresses towards a 2% goal in the near term. So even he's saying that despite the fact that we're seeing some positivity, this is probably not a trend yet. So they're not going to be cutting interest rates. Again, we've talked about how they need to be raising interest rates because if inflation is still high and continuing to accelerate, not just stagnant, but actually increasing, inflation is inflating. They need to be raising interest rates, and they're not. And we know why, because of weakness in the banking sector. So until that weakness has been flushed out, which could take oftentimes as much as 5 years, just because a lot of times a lot of this debt is refinanced on a 5-year rotating basis, or at least that's the market trend. So from where they started in 2021, 5 years out, you're probably looking at 2026 is the earliest time that they could actually look at raising interest rates further safely. That doesn't mean they won't. If they do raise interest rates, it means they're seeing such instability and inflation in the market that they're willing to take the risk on bank failures than to let the market continue without higher interest rates. So we'll see what comes of that. I am, as you know, a huge proponent of interest rates being high. I think they need to go higher. I think they need to stay high. I think it's good for the economy. I think it's good for Main Street. It's terrible for Wall Street. It's not a coincidence that every major corporation, every major hedge fund, every major private equity firm talks about we need low interest rates. We need low interest rates. You don't need low interest rates. They do, because then they have a free printing press and they can do whatever they want. So that's why I believe that, and it creates wealth inequality, and it hurts Main Street, but it supports Wall Street. That's why I think we need high interest rates. I think interest rates need to go higher. And just a couple of days ago, I floated out a scenario of how homes, 15% of baby boomers own second homes, right? And there is this, it's actually been coined as a term, the silver wave. There is this silver wave on the horizon that everybody talks about when baby boomers are going to retire and fully retire, I say, exit the job market entirely, and that they're going to be liquidating a lot of these assets. They're going to be downgrading from larger homes to smaller homes. They're obviously going to be passing away as well, but then also selling their second investment homes. When this happens, that is supposed to lower costs of home ownership because it's going to flood the market with liquidity. That could happen. But if interest rates are low, there is nothing stopping smaller investors, mid-sized investors, and mega investors like BlackRock, etc., to going in and buying these assets and then just continuing the housing trend that we've seen where you're not going to own, you're going to rent. But if interest rates are high, if they can't afford to do that, or if it limits how much they can do, then the housing market will improve. So I think this is something that we're going to see in probably the next decade. I think we're probably at least 5 years away from that. I think it's a 2030 problem, but that's why I support high interest rates, because if the interest rates are high. These mega companies and major investors can't afford to do that. They just can't take the loans out at such high interest rates in order to gobble up the liquidity in the market. They'll be restricted, and because of that, home prices will actually fall, and individuals will be able to afford them. I am always an advocate for Main Street over Wall Street, and so that's why I strongly support interest rates being high. It is good for the economy despite what you think. It's kind of like exercise. It hurts, but it's necessary. Now, another piece of good news is jobless claims are actually down. So last week I reported that jobless claims were slightly up. I mean, it was still a record low number, honestly, but it was the first time it was higher than I think the last number was set in August of 2023. In the last week, it's fallen back down again. So jobless claims for the week ending May 11th fell to 222,000 from the 230,000 that it was the previous week. So labor is actually still doing incredibly strong, despite the major layoffs that we are seeing in the economy, right? Every day I report some mega corporation having layoffs, but jobs are actually still maintaining, unemployment is staying steady. Last story I'm going to cover is Walmart. And Walmart had an amazing quarter. Revenue of $161 billion. Remember, that's per quarter. That's just how big Walmart is. $161 billion versus estimated $159 billion. One of the reasons they did this is they're targeting more high-end shoppers. So they're essentially expanding their base. Why I think that's also interesting is I think a lot of these high-end shoppers would never have looked at Walmart had it not been for inflation. This is another thing I strongly support is inequality shrinks when interest rates are high. So income inequality is on the downside because everybody's pretty much in the same pool. Inflation is hitting everybody very hard. That's not something to celebrate. Obviously, we want everybody to do well. But I think the fact that more people are conscious of prices is actually good for the economy. That's pretty much it. Those are all the stories I had to report today, mostly just inflation and jobs. I hope you guys have a great day. I will probably have a video tomorrow, but we'll see what's in the market. So if I don't see you, have a productive day and have a great weekend.